Every ETF has a story, and some of them deserve to be told. ETF Stories from Resilient Advisor brings you some of the most interesting stories from the world of ETFs. Learn more by visiting etfstories.com.
Thanks for tuning in to this episode of ETF Stories. My name is Jay Coulter, and my guest for this episode is Sean O'Hara of Pacer ETFs. They have a full suite of ETFs that covers a gamut of investment possibilities, but today we're going to focus on trend following. Sean, thanks for coming on the show.
Well, Jay, thanks for having me. I really appreciate it.
All right, so let's start at kind of a trend following 101 level, and let me tell you why I'd like to do that. In my experience, a lot of financial advisors, when they hear trend following, they think about those expensive packaged products where you would use managed futures to capture trend following results, and they were paying 5, 6, 7% commissions and were just not optimal for a client portfolio. Because of the ETF structure, you guys have been able to change that. So I'm hoping this can be an education session on trend following and then your suite of ETFs. So the first question, Sean, is, what is trend following?
Well, for us, trend following, Jay, is using a 200-day simple moving average as a barometer to determine whether we're going to own an equity index or whether we're going to have half the portfolio in that equity index or have 100% of the money in T-bills. So the product you're focusing on today, PTLC, for example, uses the S&P 500. So when the S&P 500 index is above its 200-day moving average, we believe that means it's in a positive trend. And so all of the portfolio assets will be invested in the S&P 500. If that index falls below its 200-day moving average for 5 consecutive days, we believe that's the first sign that there's not a positive trend anymore. And so half the portfolio will go to T-bills. So you'll have half S&P and half T-bills. And then from there, what we watch is the 200-day moving average itself. And if it starts to turn negative, it sort of rolls over, if you will, then the portfolio will go to 100% T-bills. And then from there, we watch the index versus its moving average again. And when it goes back above for 5 straight days, we go back into the S&P 500. So trend following for us is using the 200-day moving average to determine whether we want exposure to an equity index or whether we want exposure to T-bills or half and half, with the entire mind of managing the downside risk by owning equities. And so, we're not traditional buy and hold investors in terms of this particular product. We use this methodology to try to move away from those significant down moves in the market.
If you're interested in learning about the philosophy behind how they're managing the Trend Pilot series, visit paceretfs.com. There's a lot of great research out there. Sean, I'd like to go just a little bit deeper on that 200-day simple moving average. There's a thought out there that the exponential moving average, which is a slight deviation from the simple moving average, could provide a little quicker turn back into getting either out of the market or into the market. What was the thought process at Pacer behind using the simple moving average?
Such a great question. The research that we've done indicates that the fewer moves you make, the better your long-term experience is. And so if you use a shorter term moving average, for example, you might get out quicker or back in sooner. But what we've learned is if you run those scenarios over time, the longer moving average makes fewer decisions, and fewer decisions benefits the shareholder. Same thing would be true with the exponential moving average. It is a little bit more twitchy, if you will, perhaps, than the simple moving average. But the net result of that is that it winds up making more decisions. And so it seems sort of counterintuitive, if you will, if you're putting it together an ETF strategy that's designed to manage downside risk, that you don't necessarily want to go out as fast as possible. But the research that we've done over time indicates that the fewer decisions that you make in a strategy like this, the better off you are over time.
Yeah, so longtime viewers of this show know I'm a big fan of the simple moving average, not just because we like to keep things simple, but it's exactly what you just described. If you over-engineer your strategy, it might look good in a back test over a particular time period, but when it comes to actually executing the strategy and getting results for your clients, it doesn't necessarily do it.
Yeah, can I make one more point on that, by the way? The way it works for us is, I mentioned that 5-day period. That index has to go below its moving average for 5 consecutive business days. If you just use below 1 day as your option, again, you make far more decisions. You might get out a little quicker on some scenarios, But if you take the totality of all of those scenarios and you run a 5-day versus a 1-day trigger, again, the 5-day makes fewer decisions and actually over time provides a better investment result for the end client.
Excellent. So let's get back to the basics again and explain to viewers why trend following is important, especially in today's markets.
Well, we've been through several bear market cycles in the last 15 or so years. One was really an uncharacteristic bear market. That would be the pandemic, where, the market fell like 32% in 45 days, and then it recovered very quickly because of, unparalleled Fed intervention. But in a normal bear market cycle, if you can exit before the market bottoms out and then re-enter before it's come all the way back up, you can actually produce higher returns, we think, over time. On the slide that you're looking at, this is just an indication of just using a simple moving average and a 1-day trigger, what would happen in the last several bear market cycles that we've been through. So you can see the red line is what would be called the peak to trough decline in the S&P 500, and the yellow line would be how much your portfolio value would have gone down if you just relied on the 200-day moving average as your trading opportunity or as your opportunity to exit. And in all cases, it's less. Some cases far more or far less, but in others not quite as much. But if you're looking as an investor, and most investors today, the vast majority of money is controlled by baby boomers or people who are near in retirement, and they just feel like they can't afford to do what they did in 2008 or 2000 to 2002 again, where you have this long, protracted 2 to 3 year decline and then another 2 to 3 year climb off the bottom. And this is a tool that investors who are worried about that can utilize to minimize some of the downside exposure and hopefully opportunistically provide a little excess return over time.
And that chart can be found in some of the research that you can find on paceretfs.com. All right, Sean, let's pivot for just a minute. And I'm going to give you, it's a softball, but it actually is going to be interesting to see how you choose to answer this. How do you identify a trend?
Well, again, what we look at as moving averages, they're sort of, I don't want to get overly technical, but they are technical indicators that investors have used for decade after decade after decade. And there's different variations of these, but we just simply utilize, and the way we determine what a trend is that what the underlying asset, the index, for example, the S&P 500, its relationship to its 200-day moving average. And there's a little bit of physics involved, if you will, like a body in motion tends to stay in motion kind of thing. And so when that index is above its moving average, as I said earlier, we believe that's a positive trend. And when it falls below for a period of time, we believe that creates a negative trend. And we would rather invest in those positive trends and be long the S&P 500, for example, and not invest during those periods where things are negative, even though we might be wrong. And that once the index goes below and starts that quote unquote downward trend, it may not last forever. It could be just a correction. But the whole goal of the Trend Pilot series, and in particular PTLC, was not to time the market. It was to mitigate these catastrophic big declines that happen in normal bear market cycles so that the investor doesn't have to watch that part of their portfolio ride prices all the way to the bottom and then go back up. It's like, when you think about that peak to valley thing, the mountain, you don't have to go all the way down into one mountain and then all the way back up the other side. If you sort of say, I'm just going to cut out right here and let the market go down, if it's a normal bear market period where you have several years between that peak to the trough, the 200-day moving average will come back down and you'll get a much lower re-entry point.
And Sean, it's safe to say that if you're using the 200-day simple moving average and you have a hard set of rules like you have with your products, it takes all the emotion out of it.
It does. And that's what, emotion is probably the worst thing investors can deal with, because, I often say, if I was dealing with an individual client today and I took a risk tolerance questionnaire, and I did it today versus say 2 years ago, I would argue that most of their answers would be far different today than they were 2 years ago. And not just because they've gotten older, but they're really more experiential. In the midst of a bull market, everybody is very bullish. And in the midst of a decline, everybody turns bearish. And so eliminating those emotions can be a really critical part of putting a long-term plan together that can help people achieve their goals. And then one last thing, if you will, if you'll allow me, with regard to the ETF, there's probably some folks out there saying, well, if you're selling, what do you do with capital gains and so forth? And the ETF wrapper is really an excellent vehicle to implement a strategy like this, because there's tax efficiency in an ETF that doesn't exist in a traditional mutual fund. And so we actually can exit equities and then buy treasuries for a while and then re-enter equities. And if we've had a nice run up before we've exited, we have the ability to, because it's an ETF, shelter those potential gains. So you're not sort of lowering your overall basis. You're just keeping all the money in one place and compounding over a bigger sum over time.
Excellent. So, Sean, we've already touched on a lot of the components of PTLC, the Pacer Trend Pilot US Large Cap ETF, but I want to break it down again. So, for somebody who's new to the space, they're starting to do their due diligence on PTLC. What is the investment process for this ETF?
It's very simple. I mean, there's really only two investment choices within the ETF, the S&P 500 or T-bills. And we have a very specific set of rules that we utilize. We use the 200-day moving average, the simple moving average, versus the S&P 500's total return index. And so the rules are simple. When the index is above its 200-day moving average for 5 consecutive days, we're going to own the S&P 500 in its entirety, and that's where 100% of the portfolio will be. If the S&P 500 total return index falls below its 200-day simple moving average for 5 consecutive days, we view that as a sign that maybe we should start to become a little more defensive. So half the portfolio will then go into T-bills, and then we'll sit there and wait. We think about it, Jay, like, and there's a client video on our website that explains this, but we think of it like a traffic light: green, yellow, and red, right? Green means go. That's when the index is above its moving average. Yellow means slow down. That's when it's fallen below for 5 straight days, and half the portfolio will go to T-bills. And then red means stop. That's when the portfolio will be 100% in T-bills. And that only happens after the first signal hits, index goes below its moving average, and then the moving average itself starts to roll over and turn negative.
So, Sean, when you look at PTLC, where do you feel it fits in a portfolio?
Great question. So, I think where we see the vast majority of investors utilizing this as a complement to their traditional long-only equity portfolio. So if I own, let's say, for example, I own another ETF that tracks the S&P 500, like SPY or IVV, as if either one of those two big issuers need any advertising help from me. But if I did own one of those in a portfolio, I could pair that with PTLC. And essentially, I'm having the same exposure on the equity side, but I'm not exposed to the big declines, because the trend pilot methodology in a downward trend will move me away from equities and protect my capital by investing it in T-bills.
Excellent. So I'd like to wrap up with the chart. And this chart is from some of the research that you guys produce. And it shows the hypothetical growth of $100, which is common in marketing materials from ETF firms and mutual fund shops. But in this particular chart, you're breaking out the bull and bear markets, and it gives you what the hypothetical experience would be using some simple moving average trend following. Could you please walk people through this?
Yeah, I mean, my eyes are bad, so I'm going to have to lean into the screen a little bit to see it. But like, you have that on the far left-hand side, you've got the red bear market scenario. That's the tech bubble busting. And so you can see the peak to trough decline on equities on the S&P 500 was 47% during that period. By simply using the 200-day moving average, you would have limited that decline to about 11%. And so you don't have to ride the market all the way to the bottom. In the middle of the chart is the financial crisis. And so you'll see that's when, we had all these levered loans and people had 16 mortgages on their house, and almost every bank in the country went broke. And again, you can see that peak to trough decline there is about 55%, which, by the way, that's hard for people to deal with, especially if you're retired. It's very, very difficult to hang in there, if you will, and just buy and hold in those scenarios. That's when your emotions really hurt you the most. And we just said, just get me out. Well, again, using the simple 200-day moving average, your decline would have been limited to about 7% during that period. And then the far right-hand side, that little sliver, which technically, Jay, would be labeled as a bear market because the market went down percentage-wise as much as it needed to, more than 20%, for it to be labeled a bear market. In that scenario, the trend pilot methodology, or using a 200-day moving average, I should say, would have limited your loss to around 11%, as opposed to going down 32%, I think is what it says, or 33%. I like this chart as a setup for why you might want to start thinking about utilizing something like a trend pilot in your portfolio. I don't count COVID as a bear market. It just, there was nothing like it in history. It was a temporary thing. We unplugged the global economy. The markets sort of reacted violently, and then there was this flood of cash that limited the time frame. And so you don't, in order for a trend following strategy like PTLC to work, you need that long methodical decline in the market and then that climb back up, which we saw post tech bubble busting and post financial crisis. That particular experience there is not ideal. But I will just note that if you said, like, if you gave me this as a part, as a fact that that really wasn't a bear market, like in a traditional bear market, I would say, looking at this chart, there's an awful lot of long-term green gains in there. And bear markets tend to come around when nobody suspects they're going to come around. We all know after they happened why they happened. But it's been a while since we've had a real traditional bear market scenario with interest rates rising, inflation rising, this geopolitical crisis, an overall repricing of PEs on the market that is almost always happens when you have rising rates and rising inflation. This might not be a bad time to use a little bit of a trend following strategy like PTLC in your portfolio, just to manage your downside risk a little bit.
Yeah, Sean, so on this show, we don't do any predicting. We just look at the math and what has happened, which is why we're big fans of trend following. When you look at that chart, and I agree with you that it wasn't really a bear market back in 2020, we haven't had one in almost a decade and a half.
Yep.
And what that means is there is a generation of advisors out there that have never sat across the kitchen table from a client who's seen their portfolios collapse by 50% and believe that they're going to fail retirement, and have those protracted conversations for 2 or 3 years, like we did after the tech wreck, like we did after 2008. And trend following strategies are a great way to help potentially mitigate some of those conversations in the future.
And what was constant during that 15-year period, Jay, was low interest rates and an accommodative Fed and no inflation. Yep. And that's all looks like it's going to change. We know inflation is a problem. Anybody who's been to the gas pump or the grocery store knows it's a problem. And the grocery store probably will get worse than the gas pump. And we have a Fed now who is trying to stop inflation by raising rates and reducing their balance sheet. So that 15-year period was allowed during a very accommodative Fed policy period in a very low inflationary environment. And that's reversing itself. And so again, if you're thinking ahead, not making any prediction, because I don't know, just as you don't know whether, we're going to have another bear market this month or next year. But from an investor's perspective, if you could take a little piece of your portfolio and put it in something that uses trend following to manage your downside risk, if there's not a bear market, it'll keep going up. But if there is, you'll have at least that piece of your portfolio that'll move to the sidelines in BNT bills.
Excellent.
Without you having to do anything.
Sean, I appreciate you coming on ETF Stories to discuss PTLC. There is a whole suite of trend pilot ETFs that use different indices and implement the same strategy. To learn more, please visit paceretfs.com. That's paceretfs.com. Sean, thanks for coming on.
Thanks so much for having me, Jay. I appreciate it.